Well, you've just heard from the wonderful Bill Holter. Goodness me, didn't he have a few interesting tidbits to share with us? And we're going to go straight in now to our next speaker, Jordan Eliseo. Now, before I formally introduce Jordan, I just want to say my special thanks to the Perth Mint, who are the sponsors of today's virtual gold conference. My thanks to all the team over there for their support, because without people like the Perth Mint, I couldn't bring you all this fantastic information. Speaking of fantastic information and great speakers, Jordan Eliseo is the Manager of Listed Products and Investment Research at the Perth Mint. He is somebody I've known for many years, fabulous speaker, really understands the gold market, has some views on the crypto market, probably might have some views on silver as well, but let's get straight into it. Jordan Eliseo, thank you so much for joining us today.
Pleasure, Kerry. Thanks for having me.
Now, gold and the Biden boom. I mean, we all know Biden is finally in the White House. The virus is still around. Lockdowns are still happening, but gold is still trading a little bit sideways. So I'm really interested to hear what this talk is about. We've got a lot of investors on the conference today. So let's get stuck in. Over to you.
Yeah, sure thing. So yeah, I guess the title reflects the change in the White House. I'm sure there are some people that wish the title was different and that the result had gone the other way. It was obviously a very hotly contested election, and I think record number of votes on both sides. But we are in a world now where obviously Democrats are in the White House, control Congress. There are some important implications over the sort of medium to long term for precious metals and for financial markets off the back of that, and I'll talk a little bit about that across the course of the next half hour, and obviously look forward to questions from you, Kerry, along the way. Obviously,
and also while we're talking questions, at the end of today as well, I would recommend that if you are listening today, to make sure you register for the Zoom networking at the end of the day. Jordan, will you be on tonight at?
Absolutely, I will be. That was, we've done that before. I think that's a really great session and fantastic way to sort of wrap up a conference like this and sort of get that direct Q&A and engagement with people. So I'm looking forward to that. And obviously, I hope people have got some questions, based on what I'm going to sort of discuss in the next 30 minutes.
Great.
Yeah. So obviously just a quick one that obviously is educational in nature, everything I'm going to talk through today, and not financial advice, something pretty standard, I suppose, for people watching shows like this these days. But yeah, I just wanted to sort of highlight 4 or 5 things in the next half an hour, talk a little bit about, does it really matter who's in the White House and the implications of the presidential election, some of the headwinds for gold right now. It's obviously had a pretty choppy start to the year. Look at the Aussie dollar as well, which has been sort of flying really since the March low, when it traded almost as low as, I think it actually almost sort of kissed US 55 cents. And then finish off with a little bit about the sort of gold to silver ratio, and then the topic that almost can't be ignored these days, which is Bitcoin, if for no other reason that so much of the the media attention and things that you see on Twitter and the like are constantly trying to conflate or compare gold to Bitcoin. And so we'll sort of lean into that a little bit, and I'll share some thoughts on where I see things in that space as well. So if I start with the first topic, which was obviously probably the major political event of January this year, which was Biden entering the White House, and the sort of implications for gold from that. I think the first thing you sort of see is that gold actually sold off pretty much after the Democrats won the race in Georgia there, and sort of Congress fell to the Democrats, as it were, or control is now sitting with them. And there was a pretty understandable reason for that. You saw real yields actually start to increase, so that they were still negative, but they actually increased a little bit as effectively markets started to price in a stimulus package from Biden and his team. The number that's being bandied about is sort of US 1.9 trillion. Whether or not we actually see that, kind of remains to be seen in some way, shape, or form. But certainly that was part of the impetus to gold sell-off. Pretty much in that sort of second week of January, where it sort of fell back down into the low 1800s for a while. But the really interesting thing is if you sort of take a sort of longer term view of gold and you know, who sits in the White House, the makeup of Congress, you name it, it's pretty interesting. And the data tells us, if you look at the last 50 years, that actually who sits in the White House has very minimal effect on gold. If you look at, there's a chart that I'm showing there now, and you can see a red line for Republicans and a blue line for Democrats in terms of who sits in the White House. Those are the two columns on the left. And you can see that basically when Republicans or Democrats, you know, whoever sits in the White House, the average return on gold has been about 10% per annum. So there's no major difference there. However, what is interesting is that when Democrats control Congress, the average return on gold has been around 20% per annum. That's the quite high blue line on the right of the chart as people are looking at it. Whereas when Republicans control Congress, the return has been much, much lower. And indeed, when there's a split and no one controls Congress and you sort of have that political gridlock environment, that's actually been the worst environment for gold, and returns have only been around 3.5%. And this data comes from a report that State Street did in the lead up to the election last year. So there's some pretty interesting insights from that. I suppose the most obvious one is that, and it's a bit of a heuristic, but you know, markets kind of expect that, you know, when you've got a Democrat in the White House, Democrats controlling Congress, you're probably going to see more stimulus coming on the fiscal side. You might see more in terms of sort of taxes and wealth redistribution and the like. You're going to see larger deficits, and all of that sort of tends to feed into a sort of pro-gold narrative, as it were. And so, you know, that's pretty much the reason why you sort of see gold having historically done this. You know, gold also tends to do better when budget deficits are picking up. And of course, when the dollar is easing, which it was for the majority of last year, at least after March. So yeah, I think the takeaway for investors is that actually in the short term, you know, if anything, and I'll touch on this next, you know, what has happened in the US political situation has almost been a bit of a headwind for gold. But long term, actually, this is the sort of situation is almost the perfect environment for gold, at least if history is any guide.
Sorry to interrupt you, Jordan. Is that because, are you referring to the fact that the Democrats have stated they're going to spend almost $2 trillion? Are you saying that the more liquidity goes into the system, the better it is for gold? Am I reading that right?
Well, in this situation, it's not so much liquidity, it's just deficit spending. So, I mean, obviously the money to fund that deficit spending has to come from somewhere. And in today's day and age, at least a meaningful portion of it's likely to come from the Fed. But in this instance, we're just talking about the sort of size of fiscal deficits and the expectation that when you've got a Democrat in the White House, and particularly when you've got Democrats controlling Congress, that's the sort of environment where you tend to see more fiscal stimulus than alternatives. And so that, you know, that expectation of more fiscal stimulus, I suppose, feeds into two narratives for the market. One is that, you know, potentially you're going to get higher inflation off the back of it. Potentially you're going to get a weaker dollar off the back of it. And both of those things are typically good for gold. And so therefore you see gold tend to do well when you have, as I say, Democrats controlling Congress, at least historically.
Okay.
Yeah. So yeah, it's a good sort of segue into the next thing, which is kind of some of the headwinds for gold right now. Probably the first thing I'd say though in this is that if you look at where gold has traded in the last 6 months or sort of 5 months, it's been in a pretty clear pullback / consolidation phase. So, you know, we hit, I think that the LBMA, the price peaked at 2,067 an ounce in early August, and obviously we've been in a pullback since then. First thing I'd say about that is that it was very much an expectation that the market would need to consolidate the gains that we saw leading into August last year. And the chart that I've got here kind of attempts to demonstrate that, and I'll talk through it a little bit. The first and most obvious point to make it when looking at this chart is that the gold line just represents the US dollar gold price using monthly closing figures from December 1999 through to the end of last year. And you can see very clearly it's been in an uptrend over that time. A bear market halfway through it, but over this time period, the gold price has gone from under $500 to $1,900 essentially over this time period. So very, very strong performance. The black line, though, represents the deviation of the gold price on any given day from the average of the previous 200 trading days. So in essence, how much the gold price is trading in percentage terms above or below its 200-day moving average. That's what it's showing. And you can see that it oscillates over time. There are times where it's trading around the 200-day, then there are times that it runs quite hard, times that it sort of falls below as well. And what those the sort of little red circles on the chart are all the times over the last 20 years where the gold price had got to something like 15 to 20% above the 200-day moving average, which is exactly where it was in August last year. And if you look at what the chart is showing us, it tells us pretty clearly that every other time that gold had run that far and that fast ahead of its moving average, it had always sort of given up those gains, and the price had effectively consolidated back towards the 200-day moving average. So if you sort of take that into account, when we saw gold run as hard as it did in August last year, and there was all this fantastic media speculation of its next target $3,000, or here's why gold's going to 10 grand, and every bank was upgrading their forecasts. Actually, sort of more sober analysis of the market was telling us, look, it wouldn't be a huge surprise to see the market consolidate for a while here and at least pull back to that 200-day average, which is effectively exactly what had happened by the end of November. We then saw prices pick up in December. Both gold and silver had a pretty solid close to the year. And then we've had a bit of chop and a bit of a correction in gold, at least this year in January, as the incoming administration changing the White House, that pickup in real yields, a lot of sort of investor exuberance regarding financial markets has just kind of helped gold consolidate a bit. And I think that sort of leads into a pretty, the next topic, I suppose, which is the direction for the dollar in 2021 is going to be a pretty important driver of gold. It's not as simple as saying dollar up, gold down, or dollar down, gold up. There's a heuristic out there that thinks it's that simple, and that the US dollar is the only thing that drives gold. It's not true, but it is an important factor. And there's a couple of ways you can look at the US dollar chart. I've got the really long-term chart from the 1970s here. Clearly it's in a downtrend. So there's very little doubt about that from looking at the chart, and it's fallen, the better part of 10% since March. And a lot of people will look at what the Fed is doing, and they'll say interest rates is 0, and obviously Washington is running huge stimuluses. QE is in full effect. All of those things are a US dollar bearish. The flip side to that is that, if you look at what the ECB is doing, or the Bank of Japan, or any other major central bank, you're seeing, in percentage terms at least, like relative to the size of the economies, you're seeing similar, if not greater, stimulus being deployed in those places. And so there's a great line in one of my favorite artists is Johnny Cash, and he's got this line in a song of his where he talks about wearing his cleanest dirty shirt. And in a lot of ways, that's what the US dollar is in markets now. Is there's a lot of reasons to be bearish the dollar, until you look at the other major currencies and say, well, God, you could be even more bearish on them. And so maybe the dollar has a solid bounce, purely because it's not the euro and it's not the Japanese yen. So if we see the dollar, have a bit of a consolidation and a rally, then that's going to be a headwind for gold in 2021. And it would sort of almost make sense if it happened around now. We're in a sort of seasonally weaker period for gold right now. So that's a factor for investors to keep an eye on.
What do you think, Jordan, would be the catalyst for a turnaround in the US dollar? You say that it could potentially.
I think Look, I think, and I've got a couple of, at least one slide on this, which will talk to it. But I think it's really just the potential for another significant risk-off event, or even just the paring back of the kind of bullish expectations that we're seeing in markets. And indeed, that's the next slide I've got, around pickups in growth, around a return to normal, you name it. I actually published a piece last week where I talked about the sort of risks in the markets right now and what's taking place with COVID. If you look at the sort of market narrative, as it were, leading into the start of the year, it was, yes, COVID is a problem, but the vaccines are being rolled out. So therefore, the return to normal is just around the corner. Yes, we've had a fall in economic output, but that's all going to start coming back. Households are cashed up and ready to spend. In reality, and we've only we've seen that this week again in Australia with lockdowns in Western Australia now. Europe, the United Kingdom, US, there's still lockdowns and restrictions on economic activity. There are problems in some places, with vaccine rollouts. It won't take a lot for the market to sort of. It doesn't have to price in, what happened in Q1 last year, where it was a catastrophe. The market could just get less optimistic than what it's been. And if that was to happen, you would expect to see, a bit of a risk-off environment. Things like equity is probably correct. There's a bit of a flight to safety, and the dollar is still seen as, one of, if not the safest assets. So, there's a whole number of reasons that could drive a pickup in the dollar. Even just the Fed not being as accommodative as the market wants them to be or expects them to be. That could be, a catalyst for, the dollar putting on, 2-3%. And in the short term, all other things being equal, you could see that being a headwind for gold.
Yeah, and I think, Jordan, the other thing right at the moment is that people just seem to be a little bit euphoric because the stock market is just going yippity-doo-dah. I mean, we only have to see what happened last week with GameStop, and I don't want to go down in that rabbit hole, but the fact of the matter is that people are just pumping stimulus checks and this, what I call funny money, into the market. And therefore, I guess, do you see that as potentially a headwind for gold? Because they go, well, look at the stock market, which I literally look at it as like it's almost like a casino at the moment.
Yeah, so it's good timing. It's why I clicked through the slide deck while you were saying that, Kerry, because the sort of final thing that I wanted to bring up as a short-term headwind for gold, actually medium-term, I think it's probably going to be quite supportive, is just this euphoria in financial markets now. And yeah, in the last week, all the attention's been on GameStop, and over the last, say, few months, it's been Tesla, Bitcoin, you name it. I can talk a little bit about crypto later. But more broadly, and there's a chart that I've shared here, which comes from Citigroup, and it shows what they call their panic euphoria model, which is, it takes into account a whole heap of things: spreads, how many options are being traded, I think volume on the NASDAQ versus the New York Stock Exchange. There's a whole heap of inputs that go into it. But very simply, what they try to measure is effectively the mood of the market and whether or not it's sort of, where it sits in terms of whether or not investors are feeling particularly euphoric or whether they're actually panicking. And the data set goes back to the mid 1980s. And what that chart is telling us now is that markets, by this metric, have never been more euphoric than they are today. They're far more euphoric than what they were just before the GFC hit, and indeed even more euphoric than what they were back in 1999 when there was that huge run up in the NASDAQ, and incidentally around the time gold bottomed and started its secular bull market. So yeah, I mean, there's no shortage of warning signs for astute, risk-conscious investors in terms of what's happening in financial markets. But short term, I think it was Chuck Prince who said, while the party's still going, everybody's got to get up and dance. Short term, this is a bit of a headwind for gold, or it can be, because people are saying, well, yeah, I know the party's going to end, but right now I'm going to chase risk because it's going up, and I want to be involved in that. Moving on from that, or another way of illustrating this, and I think it's there are so many metrics by which you can measure the market. But to me, one of the simplest ones and one of the purest ways is just measuring the price to sales ratio for the S&P 500. So you're just looking at, if I'm an investor buying, effectively the S&P 500 as a whole, what am I having to pay to buy $1 of company sales that the companies in the S&P 500 are generating? And that number in January of this year had risen to basically 2.9, which meant, for every $1 of sales companies are making, I'm paying $2.90 for those sales, right, to own the stock. Now, again, if we go back to December 99, which was the sort of euphoria of the NASDAQ boom, that number was $2.30, right? So it's way higher even than it was back then. If you go back to June 2007, kind of around the time the GFC was getting started, the number was only $1.60. And at the bottom of the sort of GFC bear market, the number was just 0.8, which meant you could buy $1 of company sales for just 80 cents. Now you're paying almost 4 times that. So there is all kinds of warning signs around the euphoria in financial markets. And for astute investors trying to put together portfolios that are going to, protect and grow wealth over the long run, all of this is pretty supportive of why you would want to own gold or may want to own gold. Short term, though, it is worth pointing out that it can be a headwind if the party keeps going for a little longer.
Yeah, and none of us know when the dancing is going to stop right now. So I was just about to say, let's talk about the Aussie dollar, and look at that. It's almost like you're reading my mind.
Yeah. So look, the key thing, I think, or one of the key things for investors watching this, and for all Australian investors, it's obviously one thing to look at the US dollar price of gold, but we've got to factor in the currency side of things. Because 99% of Aussie investors are going to buy gold in Australian dollars, and the interesting thing is, if you look at 2020, all of the return gold in Aussie dollar terms was up about 14%, but all of that return actually came in Q1. It actually fell across the final 3 quarters of the year, even though the US dollar price of gold went up in every quarter, and that was very simply a function of the currency moving from roughly 56 cents-ish in March to closer to 77 by the end of the year. That's how much the Aussie appreciated. It's an extraordinary rally. But if you look at the Aussie, and this chart does a pretty good job of it, it overlays the performance of the Australian dollar versus the US dollar with just movements in emerging markets. And that's, it's a very, very clear indication that the Aussie dollar is just kind of seen as a bit of a risk proxy in the markets. So, if we're in an environment where equities are rallying, commodities are picking up, investors are getting more optimistic about growth, then all of those things suggest, that there's a bit of a bid under the Australian dollar. However, the rally has gotten very long in the tooth now. We sort of, got up to, and some people were starting to forecast that it would get back to 80 cents. Now, when we stop and think about it, Australia still faces a lot of challenges with the outlook for the economy here, and therefore the dollar, in the year ahead. We've been incredibly good relative to other parts of the world at minimising the spread of COVID. We've also been lucky. We're an island nation, and we're not particularly close to Europe or North America. But if you look at for want of a better term, the price of minimising the spread, obviously international tourism is effectively shut off. The number of overseas students coming into the country has fallen by, I think, comfortably more than 50%. Foreign demand for properties kind of, sort of dried up pretty significantly, and will continue to be impacted for years to come. And the other thing as well is that, from a commodity price performance, I mean, iron ore is the big one. I think iron ore prices more or less doubled last year.
Well, they did, George, but I think that there's a practical reason for that, because all of these governments around the globe are looking at building infrastructure projects, and so there's a huge demand for iron ore, not just out of China, everywhere.
Yeah, absolutely right. And so what I was going to say to finish the point was that you can understand why the Aussie dollar's rallied as strongly as it has. Yeah. The question is what happens now. So, the iron ore price doubled last year. It's pretty unlikely it doubles again, right? In fact, if anything, there'd be a lot of people that would suggest that, if anything, the risk, the risk is possibly to the downside now. And that, if China, it's obviously going to continue to grow, it's obviously going to continue to demand iron ore from Australia. But again, if they just, slightly pull back the throttle, that has some implications for iron ore prices. Also, if you see supply start to pick up in other parts of the world, Brazil, etc., you have the issue there. The other thing is what happens on the fiscal and monetary policy front. Now, to give you an idea there, obviously the deficit in Australia last year was something in the vicinity of 11% of GDP. I think it was about $200 billion. Which is an extraordinary number, 11% of GDP. But the other way of thinking about it is what was the gap between tax and how much was spent. And that $200 billion number is about 45%. That's how big the gap is, right? Now, obviously, the federal government is looking at winding back some of the more generous stimulus that's been provided. They're obviously still going to run deficits. They're still going to provide support, but the amount of it looks like it's going to be pared back relatively significantly this year. Now, that, if anything, puts pressure on the monetary policy front to see even more stimulus provided on that side of things. And indeed, there's chatter in the markets now about potentially a QE2 this year from the RBA. All of those things would kind of tend to suggest that there's at least pressure that the Aussie dollar, probably not going to fall back to 55 cents unless there's again another genuine risk-off event like we saw in Q1 last year. But there's at least some chance we see a little bit of heat come out of the Aussie dollar, and that supports obviously the Aussie dollar gold price. It supports the profits that Australian gold miners will earn, you name it. So
yes, we've only got a few minutes, and I want to make sure that we get to. We've got a couple of things. George, we've only got 4 minutes left, so let's go gold to silver, and then I want to go crypto.
Oh God, we have talked a long time on these things. Yeah, so look, I think maybe then just quickly on silver, I just wanted to quickly share this chart, which is the black line's the gold to silver ratio over the last 20 years. The gold line is gold. And very simply, you can see clearly that in environments where the gold to silver ratio is falling, gold itself tends to be doing very well. And by definition, it means silver is outperforming to the upside if the gold to silver ratio is falling. We had, and it's amazing because when people like you and I that work in precious metals, when you take a step back, the gold to silver ratio was rising for 9 years leading into March of last year, meaning silver was outperforming. And it was also a 9-year period where gold basically tracked sideways in US dollar terms. And there are 4 pretty good reasons for that. Commodity prices as a whole were weak. Financial markets soared like they never had before relative to commodities. There was actually pretty low overall consumer price inflation, and economic growth was actually very weak. So even though the economies were growing. So for all of those reasons, it's actually no surprise the gold silver ratio was rising for the last 9 years. But the pretty substantial outperformance we've seen in silver since March, and indeed even in January, silver was up while gold was down. All of that's suggestive that we're now in a more bullish cycle for precious metals. No guarantees, but it's definitely a sign that bulls would want to see, and sort of bodes well for the years to come. And then, the last favorite one, it's a shame we don't have a huge amount of time to talk about it, but this perennial gold versus Bitcoin debate, and hopefully we can get some Q&A later today. But, I wanted to, I suppose, highlight 3 areas of thought on this. And the first is, what is to like about Bitcoin in absolute terms, right? It just, first and foremost, it's very clearly in a bull market and people are making money being long. So you can't argue with that. It's just a statement of fact. It's also fair to say that the market narratives for Bitcoin are supportive. So all the things around QE and, rising wealth inequality, all those things, those are used to support the Bitcoin narrative, and they're understandable why people believe in them. It's also fair to say that institutional curiosity in crypto has been peaked now. In 2017, it was very much a retail-only game. It has changed somewhat now, and there's also no questioning the commitment of Bitcoin supporters. I think that they are trying to build something with Bitcoin, and they're not going to be easily put off it. So all of that's supportive. What to like about Bitcoin relative to gold, and these aren't necessarily things that I believe in, but I can understand why people do. The first of those is the promise of untold riches, right? Gold is for wealth preservation. Gold keeps you wealthy if you've already got wealth, or it protects what you've got. Bitcoin is this asset that people see going to, $1, $2, $3 million a coin. Gold's never going to do that for people. And so you can understand why people, a certain cohort of investors are attracted to that cohort, that argument about getting super wealthy buying Bitcoin. There's also the technology angle to it. Gold is fundamentally very humble. It is of the earth, and it's incredibly simple. There's no blockchain, there's no distributed ledger. There are very cool ways that gold is found and processed and refined and manufactured. But that technology angle to Bitcoin, again, really feeds into the narrative about why some people believe that it's, the future of money.
I'm so sorry, George. We are really, really running out. We're over time. I just want you to give one last comment. Guys, take a photograph of this particular slide. Sorry, George, you know what I'm like.
No, all good. We always knew we'd be pushing it up the time. Look, I think the final comment I'd just make is that Bitcoin is not a substitute for gold. It has not proven itself to be that in any case. I can understand why people are speculating in it, but if you're after wealth protection and a sort of more balanced portfolio, precious metals are, would seem to still be the safer bet, even though there's obviously nothing guaranteed in life.
And your Twitter handle, if they want to follow you, George?
Very simple, at Jordan Eliseo.
At Jordan Eliseo, and perthmint.com if you'd like to go and purchase your precious metals. My thanks to the Perth Mint once again for supporting our conference today. Jordan Eliseo, thank you for joining us.
Pleasure, Kerry. Thank you.